webinar today on option strategies. So in today's webinar, we will be discussing about various types of strategies, especially the spreads and the bullish ones. So my name is Prasenjit Biswas, and I'm your host for the day. So without much ado, uh, we will be starting off, and I'm just going to share the PPT. Yes. So I think we are able to see the presentation. All right. So basically, the mode of communication will be in both English and Hindi for the benefit of our viewers. And there is one request that in case if you face any difficulty in your video quality, then maybe you need to go and change your video settings to a higher resolution. That should help. Okay, so let's just begin with the first slide. So now, what are spreads? So when we talk about spreads, the first thing that comes to our mind in options is that maybe there will be, you know, uh, a strategy which has multiple legs, and maybe there is a gap between the strike prices. So ये spread है क्या? So कोई भी ऑप्शन स्ट्रैटेजी में स्प्रेड का मतलब यही है कि उसमें तीन चार चीज बेसिक है. सो देयर आर certain points which are very basic to the spread strategies. So firstly, any spread strategy will have multiple legs, right? So maybe you can buy a particular leg and sell the other leg. So spreads generally have 2 to 3 legs, or it can have 4 legs as well. So that is one. So spread में multiple legs होंगे, और वो जो है call और put same type के होने चाहिए. So they should be of the same type. The option type should be same, whether it's a call or a put. So that's the first point. Second point is that it has to be on the same underlying. जो मेरा एसेट है, दैट अंडरलाइंग एसेट जिसके ऊपर बेस करके हम अपना स्ट्रैटेजी बना रहे हैं, चाहे वो स्टॉक हो या इंडेक्स हो, so that has to be same. So that is the second point. And the third point that one needs to keep in mind is that these strategies could be both directional in nature, or maybe they could be neutral in nature as well. तो मतलब अगर आप कोई स्प्रेड स्ट्रैटेजी बना रहे हैं तो ये बहुत टाइप के हो सकते हैं. मतलब वेरियस कॉम्बिनेशंस यू कैन यूज, बट एट द एंड ऑफ द डे इनका या तो ये न्यूट्रल टाइप के होंगे, मतलब जो मार्केट न्यूट्रल स्ट्रैटेजीज हैं जिसमें आप शायद प्राइस के डायरेक्शन को ट्रेड नहीं कर रहे हैं, और जो हम नॉर्मली करते हैं वो है डायरेक्शनल स्ट्रैटेजीज. And the last point to remember is that they can be of various strike prices. उसमें across the strike price हो सकता है. There can be a strategy which is across expiries, or it can be both, right? So ये 4 point है जो हमको एक spread का एक general definition अगर हम सोचें, so this is what it defines. Now, what are the various types of spreads? So in terms of how they are designed, basically there are 3 types of spreads, mainly 2. 2 टाइप के ही मेन होते हैं spreads. एक हो गया vertical spreads, और दूसरा हो जाता है horizontal spread. और तीसरा जो कॉम्बिनेशन है वो एक्चुअली इन दोनों का मिक्स है, which is called the diagonal. So vertical spread में क्या होता है? Vertical spread is nothing but when you are doing a strategy which is where you are keeping the expiry same, but you are choosing different strike prices, चाहे calls के हो या puts के हो. Horizontal strategy is something which is where my strike price remains same, but I am doing the strategy across 2 different expiries. And the third will be a combination of both, where my strike price is also different and my expiry is also different. Correct? So these are at a very basic, just general understanding purpose only I'm discussing. And just to show you one more example, I mean, how it works. Basically, if you look at this slide here, so the first one on the left, the first block on the left, it is like a many various strike prices, right from 17,500 till 18,000. and the expiry date is of, let's say, 15 September 2022. Now, let's say if I choose 17600 call option and 17800 call option to set up a strategy. So in this, I am implementing the strategy within the same expiry but using two different strike prices. So it is a vertical spread, right? यहाँ पे 15 तारीख का ही एक्सपायरी है, so the expiry remains same but strike price अलग हो गया, so it is called vertical spread. Second one, if you look at, is the block which says 22nd September, and there also we have 17,500 up till 18,000 strike prices. Now let's say if I choose 17,900 call option itself, and if I'm buying and selling one of the either of the two, so in this case what happens is my strike price is the same, which is 7,900, but my expiries are different. So let's say if I buy a call option of 15th September of 7,900 and sell a call option of 7,900 of 22nd September, so that would be a horizontal spread, correct? और diagonal में क्या है? Diagonal में mix, जहाँ पे मेरा strike price is also different and the expiry is also different. So let's say if I'm taking 22nd September 17,800 call option and I'm also using 29th September 18,000 call option, so this is where my strategy will become a diagonal spread. Depends whether I buy or sell, which one I buy, which one I sell. So that is subjective. But then when I'm mixing both strike prices, different strike prices and different expiries, it becomes a diagonal spread. Now let's look at the core agenda today. So basically today we will be discussing about various bullish spreads as a topic of the webinar said. So in this primarily we will be talking about a bull call spread, second a bullish put spread, and third a ratio spread. So ये तीनों strategy जो है ये bullish है, तेजी वाले सौदे हैं, और इनको हम एक एक करके जो है समझेंगे कि ये क्या है. So all of these three are, by the way, vertical spreads. So like we understood in this slide, what are vertical spreads? We are just using the same expiry. We are not going into a different expiry. Maybe we are choosing different strike prices and different quantities maybe. So ये तीनों strategy ही जो है ना, they all come under vertical spreads. Okay. So now let's look at what is a bull call spread. So just give me a moment. Open up the slide. All right. So I think you are able to see the definition of a bull call spread. So practically, what is a bull call spread? Bull call spread क्या है? पहली बात तो ये है कि ये bull call spread is a two-leg strategy. Bull call मतलब a bullish तेजी वाला सौदा and using call options. So a strategy which uses call options to create a bullish strategy is a bull call spread. Now, how do we do it? Using two legs only. So one call option I will buy, the other I will sell. So in a bull call spread, typically what happens is that you choose to buy the lower strike price call option. Let's say आप ATM call option को खरीद सकते हैं. You can buy the ATM call option and maybe choose to sell a higher strike price call option, and that is what will create a bull call spread. So it's a two-leg strategy. Our type is vertical and we do it in the same expiry. Okay. Now there are various factors that are associated to any strategy. So first is the outlook. So when do I do such strategies? Obviously, that is very important to understand what is my view on the underlying. मेरा ध्यान क्या है, मेरे को बाजार क्या लगता है, मेरे को स्टॉक क्या लग रहा है. Depending on that, my strategy will be devised. Correct. I will not be doing a random strategy. पहले मेरे को I need to be clear what I want to do, right? What is my view on the asset? What is my view on the market or the stock? तो अगर हमारा व्यू यहाँ पे bullish है, तेजी का ध्यान है, so this is where I use a bull call spread. Now it is also important to understand that in this particular strategy, maybe I am not looking at a very massive or an explosion kind of a thing in a strategy. But nevertheless, it's not a typical, I would say, not a very, very aggressive strategy, but still it is a bullish strategy. Now, the other important thing for us to understand is that this strategy is an डेबिट स्ट्रैटेजी. मतलब क्या है कि इसमें हमारा अकाउंट से पैसा निकलता है. सो इट्स अ डेबिट स्ट्रैटेजी. मतलब इसमें हमारा प्रीमियम जो है ना वो आउटफ्लो होता है. सो हम एक कॉल खरीद रहे हैं और एक कॉल बेच रहे हैं. तो जो कॉल हम खरीद रहे हैं वो एक्चुअली ज्यादा महंगा होता है, and the one that I am selling is slightly lesser in price. So I am buying a call option, let's say for 100 rupees, and maybe I am selling a call option for 50 rupees or maybe 40 rupees. So in that case, my net outflow will be how much? 60 rupees. So it's a debit strategy. So this was the second point to be understood. And the third point is that what is my max profit and max loss? So typically a bull call spread is a limited strategy in terms of its profitability as well as the maximum loss. So what is my maximum profit? My maximum profit will be capped at the upper end of the strike price that I chose, and it will become flat after that. So typically what happens is that I mean, if you ask me this question, let's see, if I'm buying an ATM option, that's fine, but which option should I use or choose to sell? Correct. So अगर हम एटीएम ऑप्शन खरीदे ना तो हमको ऊपर वाला जो बेचना है वो कौन सा बेचें? So this is the first question that will come to my mind. So the answer is that you have a view on the stock or the index that you are trading. So उसका जो target है, that is where ideally you should sell that option, because the profit after that will become flat in the strategy, and any which way we are not expecting the asset to go above that mark. Correct. So let's see, if the stock is trading at, let's say, 500, and if I feel that the stock maximum can go up to 540 or 545 or maybe 550, not beyond that. So in that case, I might be using a 500 call option or a 510 call option to buy, and I will sell the 550 call option or maybe a 540 call option. So basically the upper end, which is where I believe is the target, and the possibility of going above which is very less. So that is the strike price that I should choose to sell the higher leg. Okay. So my max profit becomes flat above that upper leg. And how much is my max profit? So the formula is that whatever is the strike gap. Okay. So whatever I'm choosing two strike prices. So whatever is the differential between those strike prices minus whatever premium I have already paid. So for example, again, like if I bought this 500 call option and if I sold the 550 call option and my net outflow was, let's say, 20 rupees. Okay. So in that case, my max profit will be 30, because 500 and 550, the differential is 50 rupees. And how much did I pay? I paid 20 rupees as the option premium. So in that case, 50 minus 20, 30 will be my maximum profit. Now, what is the maximum loss? Maximum loss is very similar to like a normal vanilla long option. It is limited to the premium that I have paid. So maximum loss, I cannot suffer more than the outflow of the premiums. Correct. So it is therefore a limited strategy. Now, the next point is that how do I calculate the break even? So it is a very simple formula. To calculate the break even, all that I have to know is that pick up your lower strike price and add whatever premium you have paid. So let's say if I paid 20 rupees for that strategy, and if my lower leg was 500 call option, so then in that case my break even will be 520 automatically. Correct. Because on the day of expiry, and all this I'm discussing based on expiry. Okay. What will be my payoff on expiry? So on the day of expiry, if the stock, let's say, closed at 525, right? So in that case, what will happen? My 500 call option will become 25. 550 call option will become 0. So in this case, now the differential is 25 minus 0, which is 25. Correct. Now this strategy I bought at how much? 20, and I'm selling it at 25. So I'm making 5 rupees here. But let's see, if the stock closed at 520 only, then the 500 call option would have ended at 20 and the other option would have become worthless, which is 0. So ये केस में मेरा 20 रुपए मैंने दिया था और 20 रुपए मेरे को वापस मिलता. So therefore 520 पे अगर स्टॉक बंद होता है तो मेरे को कोई प्रॉफिट नहीं है. So वही मेरा ब्रेक इवन हो गया, राइट. So इस तरीके से हम ब्रेक इवन कैलकुलेट करते हैं. लोअर स्ट्राइक प्राइस प्लस वॉट एवर प्रीमियम आई एम पेइंग, नेट प्रीमियम. इसमें एक फायदा बहुत बड़ा है. जैसे क्या है कि मार्जिन के एंगल से अगर हम देखें, सो इन टर्म्स ऑफ मार्जिन यू माइट बी थिंकिंग दैट इफ आई एम selling an option, maybe there could be a huge requirement of the margin, because normally हम जानते हैं कि अगर आप ऑप्शन बेच रहे हैं, if you are selling an option, the margin requirement will be very high, correct? But since we are covered in this strategy, क्योंकि यहाँ पे कोई अनलिमिटेड लॉस नहीं हो सकता है, therefore the exchange does not charge us a huge margin or an equivalent margin as compared to the future. So as compared to the future, the margin requirements are significantly very low. Okay. And lastly, it is also important for us to understand the dynamics in terms of the Greeks. Basically, what will happen if the price moves, if there is a change in the volatility, if there is a, if one day passes by, time decay कैसे होगा. So ये एक ऑप्शन प्राइस में what are the important things? Price, second is time, and third is the volatility. ये तीन मेन है, right? So it is therefore very important for us to understand these factors also, how they behave. So they जैसे कि in our previous videos we have covered that these factors can be measured using Greeks. So for price sensitivity, which means that how much the strategy will move or the option price will move if the underlying asset moves, so that is the delta. Theta is the sensitivity of the time, and vega means kya? Volatility. Okay, so theta is time, vega is volatility, delta is with respect to the spot price. Now for a bull call spread, my net delta remains positive, obviously, correct, because if I'm creating a bullish strategy, तो मेरा जो डेल्टा है that has to be positive, correct? So if the underlying price moves, then obviously my strategy will be making money. If the underlying prices go down, then my strategy will be losing money. So that is with positive delta. Now let's say if one day passed by, what will happen? So if one day passed by, then there is a decay, correct? Time decay. And since I'm negative on theta, since I'm carrying a negative theta, so therefore if one day passes by, I will be losing money for that correspondingly. Also in terms of volatility, I lose if the volatility goes down because I'm positive on vega. So if volatility goes down, my strategy loses some bit because of the volatility factor. Conversely, if the volatility goes up, अगर volatility बढ़ गया तो मेरे को उससे फायदा होगा. So net ये एक just simple understanding के लिए है. Now इसमें सबसे अच्छी बात ये है कि just like any other long option trades जहाँ पे हम सिंगल लेग करते हैं, हमको पहले ही we know our risk. Okay. Now what will be the risk reward? That depends on what strike price you choose. So how it works is that, how do you calculate the risk reward? See, there are two things. There is a maximum profit and there is a maximum loss. So हम maximum loss तो given है, उसको we have to consider that as a given loss, correct? But maximum profit is something which we cannot guarantee. So maximum profit happens only after the spot moves beyond a certain point, correct? So the risk reward, if you calculate based on let's say max profit and max loss, then generally a bull call spread will have a greater than 1 ratio where I'm gaining more compared to the risk that I'm taking. Now again, as I said, it depends on what strike price I take. Now if I want to increase my risk reward ratio based on this, then I can go far out of for selling the higher call option. तो ऊपर वाला call option हम जितना दूर का बेचेंगे उतना मेरा theoretical risk reward तो अच्छा दिखेगा, but the probability of achieving that maximum profit will become equally lower. I'm repeating this once again. It is important to understand. If I want to increase my risk reward theoretically, like maximum profit, usko I need to increase. So in that case, I will choose a higher strike price to sell the call option, that the one that I am selling, and I will want to increase the gap between the buying option and the selling option. This gap I will increase. So the more gap I have, the more risk reward ratio will look favorable to me. But the catch is that इसमें the probability of achieving that maximum profit is going to be lesser and lesser, right? And let's say, what if in the example that I was giving, wherein the stock price moved at 520, so there is the break even. If it moved to 550, I make 30 rupees, and if it even moved to 600 also, then also I don't make more than 30 rupees, correct? Because after that the payoff will become flat. But what if the stock went to 300 or 200, or let's say if there was a crash in the market, or even if it, let's say, closed at 495 or 499? So in that case, my both the options will become zero, because I have a 500 call option and I have a 550 call option. So in this case, if the spot expires below 500, then 550 as it is will become zero, and even the 500 call option will also become zero. So in that case, whatever premium that I have paid, which is 20 rupees, will be my maximum loss. But what if it closed between 520 and 500? Let's say if it closed at 510. So in that case, I will be not actually hitting the break even. I will be losing some amount of money, but still I will be getting back some. So if it closed at, let's say, 512, so in that case, my net inflow after expiry will be 12 rupees. But overall, since I paid 20 and got back 12, तो मेरे को 8 रुपए का नुकसान होगा अगर 512 पे एक्सपायरी होती है तो, right? Okay. Now let's just quickly move on to the next strategy, which is a bullish put strategy. So it is very similar, if you look at the payoff structure, but there is a difference in terms of few of the aspects. Firstly, this is what are the common things. First, this is also a bullish strategy, but here we are using puts to create this bullish strategy. So again, it is a two-leg strategy. Again, it's a vertical strategy, and we use the same expiry. तो हम ये सारे चीजें, it is same as compared to the bull call spread. But here what happens is we sell a higher strike price put and we buy a lower strike price put. So let's say you can think of it like this. Let's say if I'm bullish on the market, what can I do? If I have to trade puts, if I'm bullish on the market, I can sell a put option, correct? So let's say, again, coming back to that example of 500 rupees stocks. So let's say if I felt that the stock is going to go to 520, 30, 40, whatever. But I'm not very, very confident, but I'm only confident about one thing, that this will not go down at least, right? I'm not very sure whether it will explode on the upside, but I'm sure that it will not go down because of whatever reason. That's my view. So in this case, what I can do is, maybe I can sell the 500 put option itself. तो 500 का ही हमने put बेच दिया. तो 500 का अगर हम put बेचते हैं, so this becomes a bullish strategy automatically, because buying a put is a bearish strategy, so selling a put is a bullish strategy. So अगर मैंने एक put बेच दिया 500 का, तो उसमें प्रॉब्लम क्या है? प्रॉब्लम यही है कि then in that case I am naked. My downside will be unlimited. So in order to protect that downside, what I do is I buy a protection put option of some lower strike price also. So for example, if I'm selling a 500 strike price put option, I might as well buy a 480 put option also. So whatever premium I'm getting by selling that 500 put option, उसमें से थोड़ा पैसा will be an outflow for buying that 480 put option also. But what will happen is that's like an insurance, because otherwise if I sell a naked put option and tomorrow if there is some kind of a crash in the market, I will be completely at a very deep loss, correct? So in order to protect that, it is important that I buy a protective put. So a bullish put strategy is nothing but a short put with a long put as a protection of lower strike price. So in this case, again, the fundamental difference is that I am moderately bullish on the stock because I don't expect the stock really to blast, but I just want the premium to to benefit from the premium decay. All that I'm sure is that the stock will not go down. So I can gain from this strategy even if the stock did not go up. So all that the stock has to do is just remain flat to positive. So if my view is flat to positive, अगर मेरा view flat to positive है, so in that case I can use this strategy, right? दूसरा फायदा क्या है? This is a credit strategy. So bull call spread में, if you remember, I said that it is a bull call spread is a debit strategy जिसमें आपको प्रीमियम देना पड़ता है. But यहाँ पे you are receiving a premium because you are selling a 500 put option and you are buying a 480 put option. So obviously 500 put option will be much more pricier than the 480 put option. So I am selling a higher price put option and I am buying a lower price put option, and therefore I have a credit info. So this is one difference which is important. Third, max profit, again it is limited, and it is limited only to the premium that I collect. So for example, let's say if I sold the 500 put option at, let's say, 15 rupees, and I bought the 480 put option at, say, 5 rupees. So how much did I get? I got 15 and I paid 5. So net I got 10 rupees. Correct? So 10 rupees is my maximum profit. I cannot make more than that, even if the stock went to 600, 700, wherever. Correct? Because the premium or the payoff becomes flat after that. Because in such case, what will happen? Nothing. Both the put options will become zero. Let's say if the stock went to 600, both the put options will become zero. So whatever premium I had collected. So that is my maximum profit. But what if the stock went down to, say, 450? So in that case, my loss is again limited to what? My loss is actually limited to the gap that I selected, that 500 and 480, this gap minus the premium that I collected. So for example, in this case, what was my strike gap? 500 and 480. So my protection starts from 480, correct? So I have sold a 500 put option, but my protection starts from 480. So below 480, both the options will, move in tandem. There's no doubt about it. But what about those 20 rupees gaps? That's where I'm unprotected. So that 20 rupees is where I can lose, but since I have collected some amount of premium, so that will be deducted. So in this case, my maximum loss will be 10 rupees because 500 minus 480 is 20, and again I collected some 10 rupees. So net I can lose only up to 10 rupees. So what is the break-even point here? So it is very simple again. So you just take the higher strike price, which is the 500 strike price, and then you subtract whatever premium you have collected. So till 490, you are not going to come at a loss. Your loss will start below 490. So let's say the stock closed at 485. So in that case, what will happen is you will lose 5 rupees net. Because the 500 put option will become 15 and 480 put option will become 0. And you have to pay 15 and you collected 10. So you collected 10, you paying 15, so you are losing 5 rupees, correct? So you are losing 5 rupees. So this is how it works. And margin, again, just like bull call spread, the margins are very similar. And coming to the Greeks part, what is the delta? Obviously, it has a positive delta. But here, unlike the bull call spread, the theta is in my favor. I have a positive theta. But the one day goes down, I gain from the time value. As I said, so I gain from the time decay, and I also gain from the volatility decay. So if the volatility goes down, I also gain from that. So ideally, I would want the stock to settle down or like calm down a bit and go upwards in a very small and steady drift. So that will keep the volatility low, correct? So implied volatility will not go up. So in that case, I will also gain from the Vega, and as it is, since it is a credit strategy, I'm selling options net. So therefore, time value is always in my favor, correct? And of course, delta, as you understood, that it is positive. Now coming to the third strategy, which is the ratio spread. What are ratio spread? So ratio spreads are very simple in one way. If you have understood, let's say, the bull call spread, from that only I will build. In a ratio spread, what happens is it is just an extension of the bull call spread, you can think. So in a bull call spread, आई हैव अ नेट आउटफ्लो। तो बुल कॉल स्प्रेड में हमको एक प्रीमियम हमको पे करना पड़ता है, करेक्ट, क्योंकि हम कुछ एक प्रीमियम खरीद रहे हैं और दूसरा हम दे रहे हैं, तो जो देते हैं दैट इज हायर देन व्हाट वी गेट। बट लेट्स से अगर हमने जो बेचा, हम अगर एक के बदले दो बेच दें, सो इंस्टेड ऑफ सेलिंग वन कॉल ऑप्शन, व्हाट इफ आई सोल्ड टू कॉल ऑप्शंस? So when I'm buying a call option, let's say of the same example that I'm taking, 500 call option I'm buying, but instead of selling the 551 lot, I will sell two lots. So what will happen is that my premium outflow, most of the cases it will turn into a credit. So instead of a debit, it might as well turn into a credit strategy where मेरा जो आउटफ्लो था उससे कहीं ज्यादा मेरा इनफ्लो हो गया because I sold two lots of the higher strike price. So that's a ratio spread. So the ratios are typically generally done in 1:2, but of course you can use more ratios, 1:2, 1:3. You can use that. So just taking this, yes, okay. So now again at a definition level, I'm using a call ratio spread. So ratio spreads you can create using puts also, but I'm taking a call example. So the view is a moderate bullish. The premium depends. Generally, it's an inflow strategy. Here, the max profit is actually limited, but then it is limited to the strike gap that I'm choosing plus the inflow that I'm getting. Right? So if you will look at the screen on the bottom left, there is a payoff diagram. It looks like a typical bull call and then cut off by a short call, correct? So it has a typical shape, and here the maximum loss is not limited. It is an unlimited maximum loss theoretically. In case if the spot goes above the highest strike price, I stand to lose unlimited amount of money because one call option that I bought, one call option I sold, so they are like covered if it goes up. But what about the second leg that I sold? Because I'm buying one and I'm selling two of higher strike price. So in case if the spot moves or the market or the asset moves above the higher strike price, in that case the second leg will be unprotected, and that will give me a good amount of loss. So break even is again a simple formula. You choose the higher strike price and whatever is the maximum profit. So maximum profit is what? Maximum profit is strike gap plus net inflow. So higher strike price plus maximum profit will be my break even point. And generally you have only one break even point, but in case if you end up into a debit strategy where you are buying but you are not selling sufficiently enough premium, and which is why you still do not have a credit, instead of a you still end up into a debit strategy. In that case you will have two break evens. So generally ये strategy में हमारा हमेशा credit ही आना चाहिए, but कभी कभी आपका debit भी आ सकता है depending on what strike price and what premium you get. Margin इसमें similar है, future की तरह ही आपका लगेगा. So in terms of the behavior of the strategy, this is where I will have a negative delta, because यहाँ पे the outlook is that I will want this asset to go up, but not very aggressively, correct? Because after a point, what happens is it will start to give me a loss. तो इसके लिए इसका डेल्टा नेट नेट हमेशा नेगेटिव ही आता है, बट एक्चुअली ये है एक टाइप का बुलिश. सो इट इज बुलिश अप टू अ पॉइंट, एंड अबव दैट पॉइंट इट विल एंड अप इनटू अ लॉस. सो दैट्स द प्रॉब्लम. Well, now just I'll take you quickly through some live examples, and here I will just share an Excel file, and we will do some kind of a live exercise and see what happened. Let's say meanwhile I'll just let me upload, and let's say on 29th of August, when market opened with a gap down, right? So on that day, market what happened? Market opened in a gap down, and by the end of the day, the markets recovered, correct? So if my view on 29th August EOD, if my view would have turned bullish, let's say if I felt that I should buy, ठीक है, आफ्टर द गैप डाउन मार्केट्स रिकवर्ड एंड आई फेल्ट बुलिश, तो मेरे को अगर उस दिन लगता कि आई वांट टू गो लॉन्ग ऑन द मार्केट, सो we'll see how these strategies would have worked up. Correct. So just can you please confirm if you are able to see the Excel sheet? Yes, I think you are able to see some kind of an Excel sheet, right? All right. So, yes. So here we will start with a uh, bull call spread. Okay. So I'm just typing in the name here, bull call spread, right? So in this, what happens is, uh, as I said, we use two call options. Let me just delete and start afresh everything. So I'm choosing an 8th September expiry, and we are going to use the prices of 29th August, which is where market closed at 17,313. Okay. So my first leg will be a call option. Second leg will also be a call option. And let's say if I am choosing the 17,400 call option as my immediate lower strike price. So 17,400 call option, and this is what I will buy. So uh, the trade price of 17,400 call option of 8 September expiry was at 163. Right? This was the closing price. So I traded plus one. I bought one lot. Okay. Now, let's say if I sold, or let me choose another strike, 17,500, because 17,400 will be a bit more pricey. So 17,500 call option was trading at 120. And let's say if I felt that markets can go up, but probably will not go above 17,800. So in that case, 17,800 call option I will sell. So that day, the 17,800 call option was trading at 40 rupees. So this is what I sell at 40. So it is easier to calculate even manually also. So in this example, as you can see, if I only bought the 17,500 call option, if I did not do anything with the 17,800 option, so in this case, it is like a straight long call, correct? Now, the interesting thing comes up when I add this 17,800 call option on the sell side. So the moment I do this, the payoff suddenly becomes flat after a point. So it becomes flat at 17,800. Now, in this case, what is my maximum profit and what is my maximum loss? So as you can see, I paid 120 and I got back 40. So net, how much did I pay? I paid 80 rupees. I hope you are able to see the screen. Can anyone just confirm? Yeah, anybody? I mean, the numbers are visible, whatever numbers I'm typing in on the Excel. Oh, great. Fantastic. So I'm paying 80 rupees, correct? So I cannot lose more than 80 rupees. So therefore, my maximum loss is 80. But what point my 80 rupees loss will come? My lower end will become flat below the lower strike price, which is 17,500. So 17,500 and below, my loss actually becomes flat at 80. I don't lose more than that. But where do I start making money? I start making money at 17,580. Can you tell me why? Very simple. Because I am paying 80 rupees. I have already paid 80 rupees, right? So 17,500 is my lowest strike price. So I have to add 80 rupees on top of it. So if I paid 80, so at least I need to make 80 rupees by the expiry. So 17,580 and above is where my profit will start. So therefore 17,580 becomes my break even point. Now I cannot make unlimited profit, so my profit becomes flat above 17,800. So this is what a bull call strategy is all about. Now we can quickly see what is the closing price today. I'm just picking up a random, rough prices today. So this strategy I initiated at how much? 80 rupees. So that was my costing. Now what is the price today? So today I think the 17,500 call is somewhere around. This is quoting at 155, and the 17,800 call is quoting at somewhere around 20 or maybe let's say 20. So it is trading at 20. So roughly now the premium is 135. बट मैंने कितना में लिया था? मैंने 80 में लिया था. तो अभी 80 का चीज अभी now it is trading at 135. Correct? So which means how much? So I am making something around just about 50 odd rupees. Correct? Net overall 55 to even considering your costing and everything. So this has given me as of now a profit of how much? 50 rupees, 55 rupees. Now there is one more day left. Correct? So tomorrow, even if it expired at this price only, and then what will happen is, let's say tomorrow market expires at 17,600, right? So in that case, my 500 call option will become 100 and this will become 0. Correct? So in that case, my net profit will only land up into a 20 rupees, because then the net outflow of the value of the strategy will be only 100. But in case if it closed at 17,700, then in that case this 17,500 call option will become how much? 200 rupees. But still your 17,800 call option will become 0 any which way. So in that case, now my strategy will be quoting at 100. So in this case, if I bought the strategy at 80 and if it ends up at 200, I will be making a profit of 120 rupees. But that's only if it expires here. Now, instead of this, so this was an example of a bull call spread. Now, let's say if we did not do all of it and instead we chose put options to set up the trade, like a bullish put spread. So again, here the first leg will be put, second leg will be put. Now on that day, again we are going back to which day? 29th of August. So markets were at 17,313, and let's say if I chose 17,400 put option, and this is what I will sell. All right. So, or maybe a 17,500. Let's take 17,500 only, because we took the 17,500 call. So 17,500 put. So 17,500 put, this is what I sell. So if I just sell it, sorry, I'm so sorry. Strike price is 17,500. Credit price is on that day 17,500 put option was 290 rupees, and I sold short. So this is a typical short put option. It's a bullish strategy, but I have not bought the second leg yet. I just have sold the put option, right? So in a bullish put strategy, I need to buy a protection. So let's say I bought the 17,200 put option because that day, that was the low, and it is always a good reason to think that that could be a support. So net, I decided that, let's say I just want to go ahead and buy the 17,200 put option. So on that day, 17,200 put option was somewhere around 147. And this is what I buy. So net, in this case, what happens is my total inflow was 143. So let's say, or 145. I sold at, I bought at 150. Let's say I bought at 150. So I sold at 290 and I bought at 150. Okay. So in this case, my combined entry price will be 140, which means that I have received a premium of 140 rupees. Now in this case, today this strategy is how much? So today I think 17,500 put option is quoting at 32 rupees. So just take a note of it. We initiated the strategy at 140. So 140 is what I received. या 140 रुपए मेरे को मिल गया. और आज के तारीख में ये जो पुट ऑप्शन है 17500 वाला, I think it is somewhere around 30 rupees, and the 17200 put option, I don't know. I mean, it could be almost zero. Correct. So let's say net this is only 30 rupees as of date. So in this strategy, I would have made already 110 rupees or at least 100 bucks here. Correct. तो इसमें डिफरेंस क्या है? डिफरेंस ये है कि this strategy, I mean, is good when you are not expecting the markets really to blast. तो अभी मार्केट उस दिन 17,300 से 17,500 600 के रेंज में अभी आ गया है, राइट? But it has not gone up to 17,800. Correct. So we are standing today at how much? More or less at 17,600 odd levels. So इसके वजह से this strategy has apparently worked well compared to the bull call spread. क्योंकि अभी वही मतलब it has gone up but not really much. Correct. So this was an example of the bullish put spread. And let's say on expiry day, what if it went above 17,800? So wherever it goes, I cannot make more than 140 rupees. This profit is fixed, irrespective of what happens. So my profit remains flat above this point, and this point is 17,500. So till the point markets remain above 17,500, I'm going to get this entire 140 rupees. So where is my loss? My loss starts at 17,360 because 140 rupees minus the strike gap. Strike gap here is 200 bucks minus 140. So 17,360 becomes my break even point, as you can see on the plot. So उसके नीचे में मेरा loss start होगा, and my loss automatically will become flat below this 17,200, and it is capped at 160 rupees. So in theory, यहाँ पे if you have noticed that you are practically, when you initiated the trade, you are operating at almost a 1:1. Correct. So generally in credit strategies, this is what theoretically the risk reward won't look good. The debit strategies, the risk reward look good because you are only looking at the maximum profit, but the probability of achieving that maximum profit is less as compared to this type of a credit strategy, which is where the initial risk reward doesn't look good, but then the probability of making that much of money, whatever little bit of money you are able to see while initiating the strategy, that probability becomes higher. So this is what is the difference. Okay. Now lastly, we were talking about a ratio spread. Now again, I'm just going back to the same example of that call option that we were discussing. So let me just go back. So this was my bull call spread that I had discussed. So 17,500 call option again. That day the prices were 120. Let me just change the price, and this was at 40. So एक typical bull call spread में यहाँ तक तो ठीक है कि मैंने I bought one leg and I sold one leg. But what if I sold instead of one, ये 17,800 का अगर मैंने एक के बदले दो बेच दिया होता, तो फिर क्या होता कि 120 तो मैंने दिया, बट उसके बदले मैंने 80 ले लिया होता. तो यहाँ पे देखिए, यहाँ पे still you are not getting into a credit because you are giving 120, getting back 80, right? So still it's kind of a debit situation here, and therefore you will have two break even points, as you can see on the screen, right? But इसका जो maximum profit है, that happens at 17,800. ये हमेशा याद रखिएगा. In a typical रेशियो स्प्रेड, हमारा ध्यान ही है कि जो पॉइंट पे हम एक्सपेक्ट करते हैं कि दिस इज द पॉइंट वेयर आई फील दैट मार्केट्स विल एक्सपायर, सो दैट्स द पॉइंट आई विल चूज टू सेल टू कॉल ऑप्शंस एंड आई विल बाय अ लोअर कॉल ऑप्शन. सो लेट्स से एट 17,313 on that day, I really did not expect 17,800 to hit. Correct. 17,800 तो मेरे दिमाग में वो तो maximum limit था. That was the maximum. But practically, let's say if I was thinking that 17,600 will be the point where the expiry will happen, somehow let's say I thought that. So in that case, 17,600 call option that day was trading at 87. And now instead of 17,500, let's say I bought the 17,400 call option. So 17,400 call option was trading at 163 that day. Okay, na? So I bought one lot of 17,400 call option at 163, and I sold 87 into 2 of 17,600 call option. तो इसमें क्या हो गया, यहाँ पे if you see, यहाँ पे I paid 163 and I got back how much? I got back 174. So net मेरे को 11 रुपए का क्रेडिट आ गया. So it's not much, but still I do not have a debit, correct? So here my whole belief or my whole view is that markets will expire at 17,600. This is where I want the markets to expire. If it expires, I make the maximum amount of profit, correct? So this is basically again just to understand from a risk reward perspective. It is something which comes with a naked risk, because what if markets went above 17,600? Because if you see, मेरा loss 17,800 से चालू हो जाता है, correct? So here, if markets really went above 17,800 because of some reason, I would have been into a loss. But again, your view has to come right. अगर view गलत पड़ गया तो obviously loss तो होगा ही. But nevertheless, you still have a very wide range of the space where you can make money. So if you see, you are making a maximum profit at 17,800, 17,600, and you are getting into a loss at 17,800 and above, correct? But what does it mean? Until markets cross 17,800, मेरा strategy profit में ही रहेगा, चाहे कम या ज़्यादा, more or less, I still will be into a profit. And the margin requirement, again in this case, let me just change this. This is a ratio spread. In case of a ratio spread, the margin requirement in case of a Nifty, I'm taking Nifty examples. So that is almost like an equivalent to a future. Because obviously आपका एक लेग तो naked ही है ना, your one that 17,600 call option is naked, correct? तो वो उसके वजह से your margin requirement will become higher. Now, in terms of ROI and everything, if you really need to check which strategy you need to choose, so not only the risk reward, but also the probability of getting that maximum profit, the probability of hitting the break evens, the probability of hitting the losses, and how much money you have to invest, how much money do you need to set up the trade. These things are actually very important for us to understand. So just only by looking at the payoff diagram or only one element of risk reward, we cannot judge which one is better. What is most important is your view. So based on your view, you can choose any of these spread strategies, correct? So with this, more or less, I have discussed in brief whatever I had to, and now we can just have a round of query sessions. Can we have the slides back, please? Yeah, okay, fine. Right, so we can just go ahead with a round of question answers now. You can post your queries on the comment section. Okay. Can you share the Excel? Just one thing that I just wanted to mention here. This is an Excel file that I just made for a demonstration purpose for this webinar. Actually, we have a KST app. There's a mobile app, and you can use all these things there, and it has a beautiful strategy developer. So you don't have to use this Excel files. You can get the live prices, and you can check all the Greeks in real time. You can please just go to the mobile application, the KST app, and you can use the strategy builder there. We are also coming up with a web version of the same, which is where not only from the mobile, but also if you are using the desktops, you can use that strategy builder as well, right? Okay, thank you, Sadiq, for the compliments. Nice payoff diagram. Um, how is the premium decided? I think the premium decided that for that question to be answered, there is a separate video that is on YouTube. You can just have a look at that video. That should explain how the premiums are calculated. Okay. What if I had purchased a lot of call and sold a put? Okay, so if you buy a call and if you sell a put, right? If you buy a call and if you're selling the put also, so if you're doing it at the ATM strike price, that will just become nothing but a synthetic future. So for example, if now markets are at 17,600 and if I'm buying a call and if I'm selling a put of 17,600 both, so that will behave just like a future, because the ATM options of both have a zero point 0.5 delta. So if you add them together, it becomes one. So it is going to behave like a future. So that's called a synthetic future. Anyway, yes, it's a synthetic future. Yes. You want to see the payoff diagram? Uh, okay. I'm just creating a. I think you are able to see this Excel again. Oh yes. Okay. So let's say 17,600 call I am buying, and what is the price today? 17,600 call option today is, I think, let's say 90 rupees. 90 rupees, and 17,600 put option, right? So this will be a put option, and I am selling it. And I don't know what is the price of the put option today. 17, maybe 65 or something. So as you can see, if I did not have this, so it is like a long call. But the moment I short a put option also, so the leg becomes straighter. The loss part from a limited, you see the difference. The loss part from a limited loss payoff, it becomes to an unlimited payoff the moment I sell a put option. So it is exactly same like a future, right? So this is what how and where from will I get the strategy builder? It is there in the KST app, and you can just download the app on your mobile. And KST, it is not case, it is KST, Kotak Securities trading app. So it has been newly launched, and there you get real time prices, you get real time all the Greeks if you want, and you can not only check the diagram on the expiry date, but you can also check the payoffs on the days before expiry, right? So maybe we will conduct another session and explain how that works. And right, so a lot of questions actually: should we sell the option? Okay, it's a good question. Should we sell the option first or buy the option first? So if you're, let's say, doing a bull call spread, if you sell the option first, it will straight away charge the margin of the future, which I might not have. But the moment I buy an option first, and then on top of it, if I sell the option, then the margin requirement will not arise. So it's important that you actually buy any leg. So if it is a two leg strategy which has a buying leg and the selling leg, it is important that you initiate the buying leg first and you add the selling leg later. Thank you so much for asking the question, Mr. Joshi. Uh, okay, and I think we need to wrap it up as well. We are well beyond the time. A lot of money is required for option selling. I mean, basically for option selling, it is the same as uh, the future trading would require, because selling options involve the same amount of risk as compared to trading naked futures. So unfortunately, that is what it is if you are selling options, and that's why using this kind of strategies can bring down your margin requirements by a huge extent. Let's say if I was just selling a naked put option, let's say if I'm bullish on the market and if I'm selling a put option, then in that case, for Nifty, I might have to pay something around 1,10,000 on today's date, approximately. I'm not very sure, but it is approximate number. But the moment if I add another leg, maybe 200, 300 points lower, if I add another put option on the long side, whereby I'm covering my downside risk, the margin requirement right from 1,10,000 will immediately come down somewhere around 30 to 35,000. So that is what is a big difference, because the return on investment is important. Because if I was selling a naked put option, obviously I would have made more money, but that would have required a higher margin also. But now that I added the put option, not only it is covering my downside risk, but it is also improving my return on investment. Correct? Right. So, I mean, a lot of interactive questions, pretty much. Questions are flowing in. I'll take just two more questions. So we should buy and sell both. That way, margin requirement will be low. Yes. So if you are getting into some kind of a spread, let's say for example, you are buying a future. So in case of a Nifty, you will have to pay 1,10,000. If you are selling a put option, you still will have to pay 1,10,000. But in both the cases, if you add a put option along with that, so that will reduce your margin. So if I'm buying a future and I'm buying a protective put, so in that case my margin requirement comes down, because that actually behaves like a call option. So मेरा risk limited हो जाता है, unlimited है नहीं. Depending on what strike price I choose, उसमें थोड़ा सा margin ऊपर नीचे होगा, but nevertheless it actually brings down nothing less than 50%. Right. Okay. Are ready-made strategies available? Yes, there are templates where you can use those things, and they're pretty handy. And of course, we will be coming up with the web version also. So that is also even going to be more powerful, and it will kind of give you a lot of data as well, which will help you to decide what you want to do. Okay, and right. So the last question that I'll be taking. Okay. Will in case of a gap down, what happens? It's a good question. In case of a gap down, see, this is where your these sort of risk limited strategies come in handy. Because if I buy a future, correct, so that day when markets bounced off, we felt that markets could go up, correct, but just remember the volatility that it had on that day. Everything was like moving so fast, going up and going down. But still, if you somehow manage to believe that markets will go up, you will still want to have some kind of a protection, because there is always this risk, and it's a real fear that I bought the Nifty future, let's say at 17,300 that day, or 400, wherever, and I believe that it will go up. But what if some news just again came in, and for the last time, if markets again gap down 500 points or 300 points lower, my stop loss of 17,200 will only remain theoretical. Because if market opens at 17,000, what can I do? Correct. So in such cases, if I have this kind of a kind of hard fed strategies which have completely well defined risk, so they are always helpful in volatile times. Yes. So yes, volatility needs to be kept in mind while initiating such strategies. So in case of a when volatility levels are high, so you might as well consider a bullish put spread if you are long on the market, instead of a bull call spread. So because if volatility is high, the moment after the event is gone, or after some point when markets settle down, the volatility will come down. So in case of a bullish put strategy, I stand to gain not only from theta but also from volatility drop, right? So this is it for the day, and I'm very very thankful to all of you for joining in. I mean, you have been such a wonderful audience today, and there are so many questions and interesting questions. I'm so sorry for to all of you, I mean, for whose questions I have not been able to answer. And that's it for the day. So hope to see you soon again. uh, Thank you so much. Thank you.